Well, good morning. Today is August 10th, 2011, and as I sit here right now, the Dow Jones is down quite a bit today as well. We definitely have been on a very volatile, in a very volatile investment market right now. Volatile meaning things go up, things go down. The one thing to remember, especially during these times, and what I talk to my clients about, is it's important to be an investor and not a trader. And what I want to share with you today is the investment decision making process, really what steps go into that, because people have a tendency of making it much more complicated than what it is, especially for your average everyday investor, and that individual that's 10, 15 years away from retirement, and they don't really feel like they have time to make mistakes. So what I want to share today is an overview of what steps or what variables go into play when you're making your investment decisions, and then as time goes on, I hope to unpack some of these topics for you in greater detail. First one that I want to talk about is time horizon. Obviously, the longer time that you have before you need to have the funds that you're investing, then the longer time you have to recover from a downturn in the market, or what is called a bear market. Just remember the difference between a bear market and a bull market is the bull market, the horns are pointing up, so you know things are going up. When things are going down, the bear has his nose to the ground. So time horizon is very significant. You don't want to be investing if you're going to need that money within a short period of time, normally 3 to 5 years. The second variable that's important in your investment decision-making process is your risk capacity. And everybody thinks of market risk or investment risk, but just about any investment that you pick, even cash, there is risk involved with that, and there's potential opportunity cost. So everybody thinks, oh, I don't want to take on too much risk, so I'm going to go put it all in cash. Well, you're just trading one type of risk for the other. And like I mentioned before, I hope to unpack that topic a little bit more. Third thing is your expected rate of return. It's always interesting when I'm talking to a client and I'm sharing with them, okay, here's how your asset mix should be. You should have some in pretty conservative assets. You can have some in more aggressive assets. And I always get asked the question, well, why do we have that in the conservative assets or the bonds, the short-term bonds or cash? I want my money to make more for me. Well, those are oftentimes the same people when we're having a down market or a bear market want to know why they're losing so much. So it's important. One of the variables is how much do you expect your rate of return to be? The fourth thing, kind of mentioned this just a minute ago, is asset allocation. What is the proper mix between stocks and bonds in your investment portfolio? Inside of stocks and bonds, I generally use mutual funds, exchange-traded funds, treasuries, fixed assets. But main thing to remember is I use some individual stocks, but from most of the people that I work with, they don't have enough zeros behind their name to buy the amount of individual stocks that they need to be properly diversified. And the fifth variable in deciding what you're in making an investment decision is to know and to understand your tax status and the tax ramifications of the investment decision that you make, and what assets you should keep in what type of qualified or non-qualified tax bucket, i.e. 401k, IRAs, qualified accounts, non-qualified accounts. But that's enough for today. Just remember the 5 variables or the 5 factors in making an investment decision is your time horizon, your risk capacity, your expected rate of return, your asset allocation, and your tax status. In other words, it's a TREAT, T-R-E-A-T. Kevin Jacobs with Step-by-Step Tax and Financial Planning, leading you to financial security one step at a time.